For most crypto traders, the signals that move the market usually come from inside the industry. Exchange flows, ETF demand, whale wallets, regulatory headlines. But sometimes, the signal comes from somewhere completely different. And right now, that signal is coming from the global oil market. A key Middle Eastern oil benchmark, known as Murban Crude, has surged above $100 per barrel, recently trading around $103. At first glance, this may sound like just another oil story, but in reality, it may be signaling something much bigger. Because this particular oil benchmark is reflecting rising geopolitical tensions, supply disruption fears, and tightening financial conditions that could eventually ripple across global markets, including Bitcoin. To understand why this matters, it helps to look at how the oil market actually works. Most people imagine oil as a single global commodity with one universal price. But in reality, oil prices depend heavily on how easily the oil can reach buyers. Geography and logistics matter as much as supply and demand. And right now, the Middle East sits at the center of that system. Every year, enormous volumes of oil pass through a narrow waterway known as the Strait of Hormuz. This strategic shipping route connects the Persian Gulf to the global ocean and is considered one of the most important energy choke points in the world. More than $500 billion worth of oil and gas trade flows through this corridor every year. In simple terms, a massive portion of the world's energy supply depends on a single, narrow passage. That means, whenever tensions rise in the region, the oil market immediately starts asking a very important question. Which barrels can actually reach global markets safely? That question has suddenly become far more urgent. Over the past week, tensions involving the United States, Israel, and Iran have escalated significantly. Military activity in the region has disrupted shipping flows and increased fears that oil tankers moving through the Strait of Hormuz could face delays, attacks, or blockades. As a result, traders are no longer just pricing oil based on production levels or global demand. They are also pricing oil based on accessibility. This has effectively split the oil market into two categories. The first category includes barrels that rely on vulnerable shipping routes, like the Strait of Hormuz. These barrels face higher geopolitical risk because their journey depends on a choke point that could potentially be disrupted. The second category includes barrels that can bypass these risks entirely. These are shipments that can still reliably reach global buyers, even during periods of geopolitical instability. And that is where Murban Crude enters the story. Murban Crude is produced by the Abu Dhabi National Oil Company in the United Arab Emirates. It is considered a premium light and sweet crude oil, meaning it is relatively easy for refineries to process into fuels like gasoline and diesel. But what makes Murban especially important right now is not just the oil itself. It is where the oil leaves from. Murban crude is exported through the Fujairah oil terminal, which is located outside the Strait of Hormuz. This allows tankers carrying Murban oil to bypass one of the world's most vulnerable energy choke points entirely. Even during periods of geopolitical tension, these shipments can still move safely toward international markets. Because of that strategic advantage, Murban has quickly become one of the most important benchmarks for oil that can still reliably reach global buyers. Refineries across Asia and parts of Europe are competing to secure these shipments. Countries like Japan, India, Thailand, and the Philippines rely heavily on Middle Eastern crude supplies. But right now, they want oil that they know can actually arrive without disruption. As tensions rise, reliability becomes just as important as price. That is why Murban crude has surged above $100 per barrel, trading at a significant premium compared with other well-known global benchmarks, such as Brent Crude and West Texas Intermediate. This price spike reflects more than simple speculation. It suggests that refiners and energy companies are actively competing for immediate physical deliveries of oil they trust will reach them safely. What makes this development particularly important is that it is happening in the physical oil market. Much of the oil market operates through futures contracts, where traders speculate on future prices. But Murban's surge reflects real demand for actual cargoes that will be delivered soon. When the physical oil market begins sending signals like this, it often indicates deeper concerns about supply and accessibility. If geopolitical tensions continue to escalate, analysts expect the pressure to spread into broader oil benchmarks like Brent and WTI. These benchmarks serve as the pricing reference for much of the world's oil trade. If they also begin climbing above the $100 level, the effects could ripple across global financial markets. Because oil prices influence something that affects nearly every asset class in the world: inflation. At first glance, the connection between oil and Bitcoin may not seem obvious. Bitcoin is a decentralized digital asset. It does not depend on traditional commodities. It does not produce corporate profits or cash flows like stocks. But Bitcoin's price is heavily influenced by global liquidity conditions. Liquidity refers to how much money is circulating through the financial system. When liquidity is abundant, investors are more willing to allocate money into riskier assets. That includes technology stocks, venture capital investments, and cryptocurrencies like Bitcoin. But when liquidity tightens, risk assets often struggle. One of the fastest ways liquidity can tighten is through rising inflation, and oil plays a central role in that process. Oil is one of the most important inputs in the global economy. It fuels transportation networks, powers industrial production, and drives the movement of goods across international supply chains. When oil prices rise sharply, the cost of producing and transporting goods increases throughout the economy. Those costs eventually translate into higher consumer prices. As inflation rises, central banks face pressure to keep interest rates higher in order to stabilize prices. Higher interest rates reduce the amount of cheap capital flowing into speculative markets. And historically, that environment has often created challenges for risk assets, including Bitcoin. The market is already reacting to these dynamics. Since the escalation of geopolitical tensions in the Middle East, both Brent Crude and West Texas Intermediate oil prices have surged roughly 30%. At the same time, financial markets have begun adjusting their expectations about future monetary policy. Investors are increasingly reconsidering how quickly the Federal Reserve might cut interest rates. These expectations matter enormously for crypto markets, because Bitcoin's strongest rallies in recent years have often occurred during periods when investors expected easier financial conditions. Bitcoin itself remains near historically high levels. Earlier this week, the cryptocurrency approached prices close to $74,000 before pulling back toward the mid-$60,000 range. It currently trades around $67,000. Volatility at these levels is not unusual for Bitcoin, but macroeconomic forces are becoming increasingly important for the next phase of the market cycle. If energy prices continue rising and inflation fears intensify, central banks may delay interest rate cuts. That would reduce the amount of liquidity flowing into financial markets. In that kind of environment, investors often become more cautious about high-risk assets. None of this means that oil alone will determine Bitcoin's future. Crypto markets are influenced by many factors, including institutional adoption, regulatory developments, and technological progress within the blockchain ecosystem. But global macroeconomic forces still play an important role in shaping investor sentiment. Right now, Murban crude trading above $100 per barrel is sending a very clear signal. It suggests that geopolitical risk is now being priced directly into the physical energy market. And when the energy market begins reflecting rising geopolitical stress, financial markets often take notice. Bitcoin remains one of the most resilient and dynamic assets in modern finance. But even decentralized assets exist within a global economic system. A disruption in Middle Eastern oil flows can ripple through energy markets, inflation expectations, central bank decisions, and ultimately, global liquidity. And when liquidity changes, risk assets often respond. So, while many crypto traders are watching blockchain metrics, exchange inflows, and ETF demand, another signal is emerging from a much older market: the price of oil. Because right now, the oil market may be flashing an early warning about the broader financial environment, and Bitcoin could eventually feel the impact.